Welcome back to the Crypto Intellect, the channel where we break down the biggest developments in crypto, banking, and institutional finance, so you can see what is really happening behind the headlines. Today's story is one that has the entire XRP community talking. The headline sounds almost unbelievable. $9 trillion, BlackRock, XRP, and a rapidly changing financial landscape. But the real question is not whether people are talking about XRP. The real question is why some of the largest financial institutions in the world appear to be moving closer to the exact infrastructure XRP was designed to support. Before we dive in, I want to hear from you. Have you noticed how the conversation around digital assets has changed over the last year? Drop a yes or no in the comments below. As always, this is not financial advice. This content is for educational and informational purposes only. Always do your own research before making investment decisions. If you find this analysis valuable, hit the like button and subscribe, because today's discussion connects several major developments that many investors are still looking at separately, instead of as one larger picture. The first thing investors need to understand is that there are two completely different narratives developing at the same time. On one side, we continue to see criticism directed at XRP from certain corners of the financial and crypto world. On the other side, we are seeing increasing institutional interest in blockchain infrastructure, tokenization, cross-border settlement, and digital asset integration. These two stories are not disconnected. In fact, they may be directly related. Whenever a technology begins moving from speculation into actual implementation, the debate becomes much louder. That is exactly what appears to be happening right now. The discussion is no longer centered only around cryptocurrency prices. It is increasingly focused on infrastructure, settlement systems, banking efficiency, and the future architecture of global finance. That shift matters because infrastructure tends to create lasting value. Speculation comes and goes, but infrastructure remains. When major institutions begin discussing the modernization of financial rails, investors should pay attention because those conversations often reveal where capital and resources are likely to flow over the coming years. Recently, a growing number of analysts have pointed to what they view as misleading narratives surrounding XRP and the XRP ledger. One of the most common claims continues to be the idea that Ripple controls the XRP ledger and therefore controls XRP itself. However, the structure of the network tells a different story. The XRP ledger operates through a decentralized network of validators and nodes distributed across multiple jurisdictions and operated by independent participants. Transactions are validated through consensus rather than a single controlling authority. Ripple participates in the ecosystem, but participation is not the same thing as ownership or control. This distinction is critical because many critics continue to use the terms Ripple and XRP interchangeably, even though they are not the same thing. Ripple is a company that develops products and services. XRP is a digital asset operating on an independent ledger. Understanding that difference is essential if investors want to evaluate the technology based on facts, rather than assumptions that may have originated years ago and continue to circulate despite significant developments in the ecosystem. The timing of these criticisms has become particularly interesting because they are emerging alongside a broader shift in institutional priorities. Financial institutions are increasingly discussing tokenization, stablecoins, real-world assets, and blockchain-based settlement networks. Those conversations naturally raise an important question. If trillions of dollars worth of assets become tokenized in the future, where will those assets settle? Which blockchain infrastructures are capable of handling the speed, efficiency, scalability, and cost requirements needed by banks and large financial institutions? This is where XRP frequently enters the discussion. The XRP ledger was designed with settlement efficiency in mind. Fast transaction finality, low fees, and cross-border functionality have positioned it as a candidate for the type of infrastructure that institutions may require as financial markets become increasingly digitized. Whether one is bullish or bearish on XRP, it is impossible to ignore that the settlement layer conversation is becoming more prominent with every passing quarter. At the same time, we are witnessing major developments involving Bitcoin's role in government reserves and institutional frameworks. Reports and public statements from policymakers and central banking officials have created substantial debate about which digital assets, if any, are suitable for reserve purposes. Prediction markets have reflected changing expectations regarding strategic reserve initiatives. Some observers have interpreted these developments as evidence that governments and institutions are becoming more selective about which blockchain technologies align with their operational requirements. The focus appears to be shifting from simple asset ownership toward practical utility. In other words, institutions increasingly want solutions that can facilitate payments, settlement, compliance, liquidity management, and tokenized asset movement. That distinction is important because it changes how investors evaluate digital assets. Instead of asking which coin has the strongest community, institutions may be asking which network can perform the functions necessary to support the next generation of financial services. One of the biggest developments drawing attention recently involves growing discussions around BlackRock and the tokenization of financial assets. BlackRock manages assets measured in the trillions of dollars and has repeatedly highlighted the transformative potential of tokenization. While headlines often simplify these conversations into dramatic claims about direct investments into specific cryptocurrencies, the broader story is actually much larger. BlackRock's leadership has openly discussed the future of tokenized securities, digital asset infrastructure, and more efficient financial markets. The reason XRP enters this conversation is because tokenized assets require settlement infrastructure. They need networks capable of transferring value efficiently across borders and between institutions. Investors who connect those dots begin to see why XRP continues to appear in conversations surrounding financial modernization. The question is not merely whether BlackRock likes XRP. The question is whether the infrastructure principles XRP represents align with the future direction of global finance, as envisioned by some of the world's largest asset managers. When people hear the phrase $9 trillion, they often imagine a massive purchase of XRP occurring overnight. That is not how institutional adoption works. Institutional transformation tends to happen gradually and systematically. What matters is not a single transaction, but the movement of financial architecture. If trillions of dollars worth of assets eventually become tokenized, every one of those assets will require a method of settlement. Every payment, transfer, redemption, and exchange will require infrastructure beneath it. This is where the settlement layer thesis becomes incredibly important. Supporters of XRP argue that the asset was designed specifically to facilitate efficient movement of value between different financial systems. Whether that thesis ultimately succeeds remains to be seen, but the growing institutional focus on tokenization undoubtedly strengthens the relevance of the discussion. Investors should focus less on sensational headlines and more on understanding the underlying infrastructure requirements driving these conversations. Another development that has attracted significant attention comes from Japan. Financial institutions across Japan have continued exploring and implementing blockchain-based technologies for payment and remittance solutions. International remittances remain one of the most expensive and inefficient areas of traditional finance. Cross-border transfers often involve multiple intermediaries, delayed settlement, and unnecessary costs. Solutions capable of reducing those frictions naturally attract interest from banks and payment providers. Ripple's technology has repeatedly appeared in discussions surrounding international payments because of its focus on speed and efficiency. When a bank adopts blockchain-based infrastructure for live operations, that decision carries more significance than speculation on social media. Real-world deployment demonstrates utility. It shows that institutions believe the technology can solve actual business problems. That distinction between speculation and implementation is becoming increasingly important as the digital asset industry matures. The broader banking story extends far beyond any single country. Around the world, financial institutions are exploring ways to modernize payment systems and improve operational efficiency. The existing global financial system was built decades ago and often relies on processes that were never designed for today's interconnected digital economy. Delays, settlement risk, liquidity constraints, and compliance complexities create inefficiencies that cost businesses and consumers billions annually. Blockchain technology offers potential solutions to many of these challenges. The reason XRP remains part of the conversation is because it was specifically developed to address value transfer and settlement issues. As more institutions evaluate modernization strategies, the demand for efficient settlement networks may continue to increase. Investors should recognize that the opportunity being discussed is not limited to cryptocurrency trading. It involves the potential restructuring of financial infrastructure on a global scale. At the same time, the debate surrounding Bitcoin and XRP continues to intensify. Bitcoin has established itself as the dominant digital store of value asset and remains the largest cryptocurrency by market capitalization. However, many analysts argue that store of value and settlement infrastructure are two different categories. One network may excel at preserving value, while another may excel at facilitating transactions. This distinction often gets lost in online debates, where every digital asset is treated as though it must fulfill the same purpose. Institutional decision-makers may not view the market that way. They may evaluate technologies based on specific functions and use cases. If the future financial system includes multiple layers, different networks could potentially play different roles. Understanding that possibility helps explain why XRP continues attracting attention, despite years of criticism and skepticism from portions of the market. Another factor contributing to XRP's growing visibility is regulatory progress. For years, regulatory uncertainty created significant challenges for both investors and institutions. Large organizations generally avoid committing substantial resources to technologies operating in unclear legal environments. As regulatory clarity improves, institutions gain greater confidence in exploring digital asset opportunities. This does not guarantee adoption, but it removes barriers that previously slowed participation. Regulatory developments in the United States and other major markets have therefore become closely watched indicators. When institutions believe the rules of engagement are becoming clearer, they are more willing to invest time, capital, and resources into blockchain-related initiatives. XRP supporters often point to this evolving regulatory landscape as one of the most important developments supporting long-term adoption potential. Market performance has also reflected growing investor interest. XRP experienced substantial gains during periods when institutional optimism increased and regulatory concerns eased. However, price alone does not tell the full story. Long-term investors frequently focus on underlying developments rather than short-term market fluctuations. Partnerships, infrastructure deployments, technological improvements, and policy shifts often provide deeper insight into future potential than daily price movements. This is why many experienced investors spend more time studying adoption trends than chart patterns. They want to understand whether the technology is becoming more relevant within the broader financial ecosystem. In the case of XRP, supporters argue that growing institutional engagement with blockchain infrastructure validates a thesis they have held for years. Critics disagree, but the conversation itself demonstrates that XRP remains one of the most closely watched assets in the industry. Think about the perspective of a professional who has spent decades working in finance. They are not evaluating cryptocurrencies based on memes, hype, or social media excitement. They are evaluating systems based on efficiency, cost savings, scalability, and operational effectiveness. If a technology can reduce settlement times, lower costs, and improve liquidity management, it becomes worthy of consideration regardless of public opinion. This perspective helps explain why infrastructure-focused discussions continue gaining momentum. The future winners may not be determined solely by popularity. They may be determined by which technologies solve meaningful problems for banks, asset managers, governments, and enterprises. That possibility is one reason the settlement layer narrative continues attracting attention from serious market participants. The most interesting aspect of the current environment is how multiple signals appear to be converging simultaneously. We have central banks discussing reserve standards, we have asset managers discussing tokenization, we have banks implementing blockchain-based solutions, we have regulatory frameworks evolving, we have increasing conversations around digital settlement infrastructure. Each development may appear isolated when viewed individually. Together, however, they form a broader picture of financial transformation. Investors who focus exclusively on price may miss these structural shifts. The biggest opportunities often emerge when infrastructure is being built, before widespread public recognition arrives. Whether XRP ultimately becomes a dominant settlement asset remains uncertain, but the relevance of the infrastructure conversation is becoming increasingly difficult to ignore. What makes this moment particularly fascinating is that opposition often becomes loudest when an idea starts gaining traction. Technologies that pose no competitive threat rarely attract sustained criticism. When significant resources are devoted to challenging a narrative, investors naturally begin asking why. Is the criticism based on legitimate concerns, competitive interests, misunderstanding, or some combination of all three? Every investor must answer that question independently. What cannot be denied is that the debate surrounding XRP has evolved. It is no longer merely about cryptocurrency speculation. It is increasingly about the future design of financial systems and the infrastructure that may support them. That shift alone represents a major change from the conversations that dominated the market only a few years ago. When we pull everything together, the picture becomes much clearer. Discussions involving BlackRock, tokenization, settlement infrastructure, banking adoption, regulatory developments, and cross-border payments all point toward a single theme: modernization of global finance. XRP remains at the center of many of these discussions because of the role its supporters believe it can play within that modernization process. The $9 trillion headline captures attention, but the deeper story is about infrastructure. It is about the possibility that financial markets are gradually moving towards systems requiring faster, cheaper, and more efficient settlement mechanisms. Whether XRP ultimately becomes one of the biggest beneficiaries remains an open question. What is no longer open for debate is that institutions are actively exploring the technologies that could shape the next era of finance. The pattern forming right now is not random. It is institutional, measurable, and increasingly visible. Let me know in the comments below. Do you believe XRP is positioning itself as the settlement layer for the future financial system? Or do you think another blockchain will ultimately take that role? If you enjoyed this analysis, make sure you like, subscribe, and share this video. Stay informed, stay focused, and I'll see you in the next one.